Know the difference with Annex Wealth Management? Has this ever happened? You got a question. Somebody has an answer. But as they go on, they start slipping into jargon. Jargon is specialized language or terminology. If you know, you know, and you can understand. Insiders use it to communicate effectively. The rest of us, we don't know what they're talking about. It can even happen on this show. Brian Jacobsen, Chief Economist, Annex Wealth Management. Matt Morzy, Director of Research with the Annex Wealth Management Investment Team. Both these guys well-versed in jargon. They're here to help us navigate phrases you might hear, but not quite understand. Let's start with asset allocation.
Sure. Yeah, and I love jargon. Sometimes I probably invent some as well. I think I'm prone to doing that. But asset allocation is a word that's thrown out there, but oftentimes not very well defined. The best way that I think about it is in terms of you've got a lot of investment opportunities out there in terms of stocks, bonds, commodities, currencies, all sorts of things. How can we maybe put these into categories, right? So when you talk about stocks and bonds and commodities and currencies, those could be asset classes. Okay, so asset allocation is just the process by which investors put their money into those broad categories. So it's kind of this top-down view about, I'm going to put a certain amount in stocks, certain amount in bonds. That's asset allocation. But asset allocation needs to have a purpose. It needs to be aligned with your goals and your risk tolerance, because otherwise you're just throwing money out there.
Matt, when we're talking about volatility, it seems fairly obvious.
And it certainly can be, but again, sometimes we make these things more difficult than they really need to be. But how I kind of think of volatility is what is the different ranges of outcomes in different asset classes, as you were mentioning, part of that asset allocation, are going to have different levels of probably historical and expected volatility in terms of how much they can move. We typically think of equities as being more volatile than bonds are, but not always, not all of them. But we like to look at that in terms of standard deviation. So what are those different ranges of outcomes that you can see there? And volatility in and of itself is not a good or a bad thing. In fact, a lot of times you really like volatility when it's going up and things are going up and to the right and the stock market looks green. That's great volatility. We all love that volatility. We don't like when it looks red and things are going down. That's a volatility everybody's trying to get away from. But in and of itself, the volatility is not bad. It's really just what are the possible things and how wide can those different bands be?
Hey, Brent, how about diversification? Is that a cousin of asset allocation?
It is, and volatility. So the two go together. And the idea is with diversification, it really boils down to that old maxim, don't put all of your eggs in one basket, right? Can you hold a large number of different investments that maybe one is more volatile than the other, or the way that they zig and zag, that they don't go in the same direction at the same time? So really diversification, again, it has a purpose. The point is, given expected return, is to reduce the volatility or to make a smoother ride in getting there. So diversification really combines asset allocation and volatility, trying to do asset allocation to reduce that volatility or to hit a certain target volatility that you're actually comfortable with.
Here's one that got me a lot early, and we use it a lot: liquidity.
That is a great one. And liquidity really refers to how easy is it to take an investment and get it into cash without changing the price that you're going to get from it. So you think cash, extremely liquid because you either have it in your pocket or it's in your bank account and you can write a check or use a debit card to get off of it. You think of stocks. Stocks are generally going to be pretty liquid. You can go onto your brokerage account or have somebody sell something. Generally, it's turned to cash pretty soon. Some stocks are very liquid, others not so much. It depends on how much trading volume there is every single day. Those really big, magnificent 7 type stocks are really easy to get in and out of. And because they're so big, you and I are not changing the price to get out of it. But there might be some really small publicly traded companies that don't trade at all during the day. And same thing with fixed income too. You might have days, weeks, months where a bond doesn't trade. And in order to get out of it, that price is going to change quite a bit. And so you can turn it into cash, you're going to meaningfully affect the price when you're going to do that, which means it's a less liquid type investment. And even further out on that spectrum, you're going to think of a lot of things like alternatives, whether it's gold bars and you need to go find a place that's going to take the gold bar and convert it to cash for you. And who knows what you're going to get for it then, or something like private equity. You might not be able to get out of it until a quarter from now, a year from now, 10 years from now, without either having the access or a pretty big fee in order to get out. So those are things that affect the liquidity of an investment.
Jargon is everywhere. It's communication shortcut, but it can be exclusionary if we don't know what it means, and that is the purpose of this segment. This is part 1. Stay tuned for part 2. Brian Jacobsen, our Chief Economist at Annex Wealth Management. Thanks.
Thank you.
Matt Morzy, Director of Research. Thank you.
Thank you.